One of the world's most developed economies is that of China. They are competing to become the world's reserve currency, replacing the US dollar. 20% of the things we use on a daily basis are produced by them. They are also, without a doubt, in danger of experiencing a total financial collapse, which would obviously have an impact on the rest of the world. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. Real estate is often the beginning of this, as residents chose to invest in real estate as a safety net over other forms of investment over the past few years. China has seen what many would term as a real estate bubble, with double-digit annual real estate market growth. In addition, the urbanization of the majority of rural China and the social pressure to own a home led to a large-scale migration to cities that provided more opportunities and potential for higher earnings, further increasing demand. In actuality, the nation was constructing 5 times as many homes as America and Europe put together, yet the market was still so tight. But there was something else that was wrong. People would purchase anything because they thought the housing market was such a good investment. They were able to, because they could always sell it in the future for a profit, even if they didn't live there. Property values at the time were rising so quickly that developers would pre-sell units, requiring the buyer to start making payments on a home that hadn't even yet been built, with the belief that given how quickly property values are increasing, it will be more affordable to buy now than it will be later. Also irrelevant was how much it cost. Home buyers would borrow money from their family and spend up to 23 times their annual income on a home, with a mortgage sometimes eating up more than half of their gross income. As a result, there are 22% fewer vacant homes in China, as home buyers purchase second properties, just as the government stepped in to buy the excess inventory to maintain market stability. Investment was allowed without restrictions just outside of the city limits. Additionally, the increased demand for construction resulted in less oversight of construction quality. Of course, this will result in serious construction issues as developers try to maximize profits by cutting costs. However, there is a much bigger issue. Unfinished pre-sale units were present. It's even been disclaimed that some of the biggest real estate developers were using pre-sale funds as down payments on new projects. Even more surprising is the fact that pre-sales and deposits accounted for more than twice as much funding for developers in 2019 and 2020 as did bank loans. Additionally, capital raised through pre-sales is entirely interest-free, in contrast to bank loans and bonds, which typically have annual interest rates of at least 5%. Today's reality is a city of dashed hope and unfinished housing projects owned by 8 struggling real estate developers who lack the funds to continue while work has completely ceased in the middle of a project. Due to a lack of funding, an increasing number of projects have gotten behind schedule or outright abandoned their construction. All homeowners with unpaid mortgage loans have been ordered by buyers to stop making payments until construction has been restarted. Similar protests against more than 320 projects in about 100 cities erupted within 4 weeks, causing markets to soar and forcing authorities to seize banks and developers in order to quell the unrest. Since February 2021, there has been a sharp decline in home sales and property investments, while at the same time, the credit market grew at an alarming rate, and developers took on increasing amounts of debt to stay afloat. Even the Federal Reserve of the United States publicly warned that if conditions in China's real estate market deteriorated sharply, they might spread to the United States. What steps is China taking to address this? And why does it seem that things will only get worse from here? China has announced that it has tightened regulations by monitoring customer funds and guaranteeing prompt delivery of new units. The real estate market, however, is exposed to 96% of the Chinese population, since 13 million units have already been halted in the past year. It is inevitable that this trend will spread to other industries, including the bank sector. However, it might not be sufficient to restore their customers' full confidence in the banking industry. A system known as fractional reserve banking is used both in China and in the US, where banks are only required to hold 10% of their clientele's assets. The remainder could either be freely lent out or lent to other organizations for profit. But starting in 2019, China has relaxed these reserve requirements to encourage more spending and, in turn, temporarily stave off the economy slowing. But if more of their customers demand their money at once, the risk of a bank run increases. Money returns simultaneously in full. Consumer confidence in the Chinese economy has declined as a result of this occurring, at the same time that their population has lost faith in the real estate market. The less money is borrowed, the less people trust banks. Developers abandon projects when there is a lack of demand for real estate. As people withdraw money from the system and defend what is left, the cycle is repeated to a greater extent. Delaying the inevitable is the one thing China has excelled at though. By paying some accounts back, signaling the international trade, and possibly saving financially troubled developers by making additional loans. Lending money is the simple solution to over-leveraged properties. However, it is anticipated that this new fund will be able to raise up to 300 billion yuan, which may be just enough to regain market confidence while waiting for the economy to recover. According to a source familiar with the situation, as part of the government's effort to increase rental housing, this fund would finance the purchase of unfinished home projects, fund their completion, and then rent them to individuals. Some people might believe that they are unaffected in the United States, and that it only affects China. That's not exactly true. As you can see, the United States has significantly increased its investments in China over the past 10 years, ranging from major institutions to regular individuals. It's important to note that even though we have over $118 billion invested in China, that sum represents a relatively small portion of the overall size of the American portfolio. However, Chinese businesses are also heavily exposed to the American market, and it would make sense that they would sell those assets to raise capital when they needed it, which would cause the stock market to become much more volatile. The real effect on Americans as a whole is not so much a change in policy or a decline in the stock market. Rather, the investor perception that things could get much worse. Fractional reserve banking, for instance, has been practiced in the United States since 1791 and is protected by regulations and the FDIC's Code of Conduct to prevent banks from simply stealing customers' funds. Though in China, it hasn't always been the case. For the majority of our lives, this hasn't been a cause of concern. They have made abundantly clear that they will stop at nothing to keep the market protected. However, it seems that there are too many bad actors looking to abuse the current system without strict oversight, and that might only postpone the inevitable. Although it's too soon to predict how this will turn out, it has been noted that China won't meet its target for annual economic growth. Very quickly, we're coming to the conclusion that China's days of rapid economic growth are long gone. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.